Oil headlines shoved 90 back onto the screen this week. And if you're still treating that number like a prediction, you're already behind. Because the tape didn't print $90. The tape printed something more revealing. Brent stayed in the low 60s, while silver ripped roughly 8 to 10% higher in the same week. That split matters. It is the market pricing two different dangers at once: supply risk in energy and monetary risk in metals. Here, as the first pressure point, $90 oil is the level people talk about when geopolitics turns into barrels disappearing. But talk is not price. Realized pricing is what closed. And over the last week, realized pricing was a controlled risk premium in crude, not a breakout. If you're waiting for crude to confirm the story before you pay attention, you're late, and that matters. Markets don't reward spectators. They reward people who read the tape while it's still forming. Now walk it day by day. Monday, January 5th, the week opened with geopolitics back in the driver's seat. Venezuela and Iran were the headlines that forced traders to ask the only question that counts in energy. Will this disrupt flows? Not, is demand strong? Not, is growth accelerating? Will barrels get delayed, rerouted, or priced with higher insurance and shipping costs? But there was a second force holding the line: inventories and the oversupply narrative. When the market believes barrels exist, but the route, the paperwork, or the enforcement regime is uncertain, you get a premium. You do not automatically get a sprint. That's exactly the behavior you saw. Crude responsive, not panicked. The price acknowledges risk, but it doesn't scream shortage. Metals opened the week with a different posture. Gold and silver weren't trading like simple commodities. They were trading like protection. The market wasn't buying industrial optimism. It was buying insurance. And if you're still framing silver as only an industrial input, you're using last decade's model on this decade's market. Silver is the bridge, part monetary hedge, part real economy metal. When stress shows up, it can be pulled from both sides at once. Tuesday, January 6th, crude stayed headline reactive. The market kept measuring every update by the same standard. Does this turn into real friction, real delays, real rerouting, real cost? Oil moved, but it moved in a measured way, like a premium being written into price rather than a shortage being screamed into existence. That's what an oversupply backdrop does. It caps the upside unless the stress becomes physical, and that's why you can't wait for obvious confirmation. By the time it's obvious, the repricing is already in the candles. At the same time, the precious metals bid held. That's not narrative, that's plumbing. When policy expectations lean easier, the opportunity cost of holding non-yielding hedges drops. And when uncertainty rises, the demand for monetary hedges rises with it. The transmission lines are simple: rates, the dollar, and liquidity conditions. You can argue the story all day, but you can't argue the mechanism. Then, Thursday, January 8th, energy printed a clean risk premium day. Brent jumped about 3.4% and settled near $61.989. WTI was up about 3.8% to roughly $57.76. That kind of move doesn't require a demand shock. It requires supply risk headlines that traders can't ignore. Friday, January 9th, oil extended the rebound. Brent added roughly 2.2% and settled around $63.34. WTI gained about 2.4% to about $59.12. On the week, Brent finished up about 4% and WTI about 3%. Read that carefully. Up? Yes. Exploding? No. That is the profile of a market pricing geopolitical premium while still anchored by the idea that supply, overall, is not yet broken. Crude is saying, I see the risk, but I'm not convinced the barrels are gone. That's what controlled premium looks like in real time. 2 strong up days, higher closes, but still inside a range that tells you inventories and spare barrels are still part of the conversation. It's a market paying for protection, not one bidding in desperation. Now look at what happened at the same time in precious metals, because this is where most people get caught off guard. By Friday, spot gold was near $4,496 and up about 3.9% on the week. Spot silver was near $79.56 and up about 9.7% on the week. Silver didn't just rise, it outpaced gold by a wide margin. That's not an accident. Silver is a higher beta market. It's thinner, it's more flow sensitive. When the market is buying protection, silver doesn't whisper, it amplifies. The cost of that amplification is volatility. If you want the upside, you pay with larger intraday swings. And there was a second amplifier hiding in plain sight. Early January is rebalancing season for large commodity benchmarks. Those flows can force mechanical selling or buying that has nothing to do with what you believe. If you trade only your beliefs and ignore the calendar, you're late, and that matters. In a market as thin as silver, mechanical flows can widen intraday ranges even while the underlying direction remains buy protection. That IX, how people get shaken out on the way up, they mistake flow-driven volatility for a change in trend. So if you were watching only one slice of the system, the move looked irrational. It wasn't. Oil can price supply risk and still remain range-bound when inventories and oversupply themes persist. Metals can accelerate when the market simultaneously reassesses rates, policy expectations, and the credibility of the system those rates are meant to stabilize. This is the split screen you need burned into your brain. Crude priced risk in a controlled way. Metals priced stress in an aggressive way. Same week, same headlines, different message. And when you see that divergence, controlled crude, aggressive metals, you're looking at a market preparing for stress without yet declaring a full-blown supply shock. If you're still waiting for a single headline to explain everything, you're late. What matters is the sequence. Controlled premium in crude, aggressive hedging in metals. That is a market stress test happening in real time. Next, we tighten the chain. We'll map exactly how geopolitics becomes an oil premium without becoming a breakout, then show how that feeds inflation expectations, rate pricing, and the demand for monetary hedges, and why silver can outrun gold even when both are responding to the same macro signal. You want the clean chain, not the noise. So here it is, how the same week can hold $90 oil talk, low 60s closes, and a silver surge that makes people feel like they missed something. Because they did. Start with crude. Thursday, January 8th, Brent jumps about 3.4% and settles near 61.999. Friday, January 9th, it adds roughly 2.2% and settles around 63.34, while WTI finishes near 59.12 after a strong Thursday rebound. Weekly performance. Brent about plus 4% and WTI about plus 3%. That is not a market screaming shortage. That is a market pricing a premium for risk, one that can expand or evaporate depending on whether headlines become physical friction. This is the distinction most people refuse to make. Geopolitics is not automatically bullish oil. Geopolitics is bullish oil only when it changes the flow of barrels, the cost of moving barrels, or the willingness of buyers and insurers to touch those barrels. If you ignore that filter, you will misread every move. This week's premium was built on that exact filter. Venezuela was not no oil. Venezuela was how does the oil move? Under what rules, with what counterparties, and with what enforcement risk? When the market is forced to price operational uncertainty, shipping, sanctions, paperwork, insurance, the first reaction is usually a premium, not a breakout. Because uncertainty raises costs before it removes supply. Costs can be priced in hours. True supply loss takes time to prove. Iran was the other edge of the same blade. When internal instability and regional tension rise, the market does not wait for a confirmed outage to start pricing the possibility. It writes the premium first, then decides later if it needs to write more. That is why you got 2 strong up days without escaping the range. It is the market saying, I can't ignore this, but I'm not buying a full supply shock yet. Now look at the ceiling that kept the premium controlled. The oversupply theme did not disappear. OPEC's output has been discussed around the 28.4 million barrels per day range, and U.S. drilling activity is still in a regime where the market believes supply can respond over time. Even the rig count drifting lower, around the mid-500s, does not instantly remove barrels from the system, so $63 is not $90. The premium is present, but the base case is not broken. That's what traders mean when they say $90 is back on the screen. It's not a forecast. It is a risk threshold, the level that becomes plausible if the premium turns into physical disruption, or if inventories start drawing hard and consistently. This week, you did not get that confirmation. You got the premium, capped by the supply backdrop. Here's where the chain flips into metals, and where most people get psychologically trapped. They keep waiting for oil to confirm stress, while metals start pricing it anyway. If you need crude at $90 to believe stress is real, you're late, and that matters. On Friday, January 9th, the macro trigger was clean. U.S. payrolls. Job growth came in around 50,000 versus expectations near 60,000, with the unemployment rate around 4.4%. That combination shifts the rate conversation in one direction. Easier policy becomes more plausible, and the market leans harder into the idea that the next chapter is about cuts, not hikes. When that belief strengthens, it shows up fast, through the dollar, through yields, and then through the metals tape. And that is the mechanical backbone for gold and silver. When traders price easier policy, the opportunity cost of holding non-yielding hedges falls. When uncertainty rises, the desire to hold those hedges rises. Put them together, and you get a bid that does not need a story. It needs a curve and a calendar. So gold holds near 4,496, up roughly 3.9% on the week. Silver, thin, volatile, flow-sensitive silver, prints near 79.56, up roughly 9.7% on the week. Do the math, and you see the message tighten. That puts the gold-silver ratio in the mid to high 50s, meaning silver is catching up in a hurry. That is not everyone got surprised. That is everyone who watches only one market got surprised. Silver did not move because someone suddenly discovered a new industrial use on Thursday. Silver moved because the market bought protection, and silver amplifies protection flows. It always has. The surprise is not the move. The surprise is how many people still pretend silver trades like a normal commodity. Now add the second engine that makes people feel like they are losing control: forced flows. Early January is rebalancing season for major commodity benchmarks. When large indexes rebalance, they can generate mechanical selling or buying that has nothing to do with conviction. Think of it as a tide. You can swim against it, but you will look wrong and you will get tired. Reports this week pointed to roughly $10 billion in index-linked pressure tied to annual rebalancing. In a market as thin as silver, that kind of mechanical flow can widen intraday ranges, even while the underlying macro message stays intact. That is why you can see silver rip on the week and still whipsaw traders day to day. The direction is macro. The turbulence is microstructure. If you judge the trend by the turbulence, you will get shaken out on the way up and call it manipulation after the fact. That is a coping mechanism, not analysis. So the chain is not complicated, it is ruthless. Crude prices, a controlled geopolitical premium because uncertainty raises costs and risk. But the oversupply narrative caps the move. Metals price the monetary channel because payrolls and rate expectations shift the opportunity cost of hedges. Silver outpaces gold because it is thinner and higher beta, and rebalancing flows make the ride violent enough to shake out anyone who needs comfort to stay in. If you are still trying to trade this using one variable, oil up or jobs down, you don't relate. The market is pricing a basket, and in the next few sessions, the calendar is going to test that basket. Tuesday, January 13th, brings the CPI print. Wednesday, January 14th, brings the EIA inventory report and the Fed's Beige Book. Then you're staring at the January 27-28 FOMC meeting and an OPEC Plus meeting on February warrant. None of those events need to change anything for volatility to rise. They just need to force positioning to reveal itself. That is the real setup. Not a story, but a schedule. And if you wait for the headline after the data, you're late, and that matters. Here's what most people underestimate. The next few weeks, Dun-IT need a new crisis to produce new prices. They only need clarity. When a market is already pricing two risks at once, supply risk and crude and monetary risk in metals, every major data release becomes a forcing function. It doesn't create the move. It exposes who is leaning the wrong way and who is hedged correctly. Start with what the tape already proved. Oil rallied hard on Thursday and Friday, yet it still closed the week in the low 60s. That is the signature of a market paying for insurance without declaring an outright shortage. In that regime, crude is hypersensitive to anything that changes the odds of physical friction: shipping, sanctions enforcement, port operations, insurance pricing, and the credibility of export arrangements. It is not trading like a pure growth story. It is trading like a risk story with a hard ceiling until the market sees persistent tightening in real barrels. That ceiling is exactly why inventories matter more than usual right now. When crude is range-bound and headline-driven, a single weekly stock report can shift the narrative from premium only to premium plus tightening, or back to premium fades. When inventories are the swing factor, price reacts fast and then immediately tests whether it can hold. That is why you can get two-day bursts and still remain inside a band, and why the market can talk about $90 while the realized close sits near $63. Now, layer inflation on top of that. Oil doesn't need to be at $90 to move inflation expectations. It only needs to stop falling and start rising in a way that looks persistent. This week's move did exactly that by putting energy back into the conversation. Once energy is back in the conversation, rates are back in the conversation. Once rates are back in the conversation, gold and silver stop being commodities and start behaving like monetary hedges again, because the trade becomes about policy credibility and the opportunity cost of holding protection. That is the short-term roadmap. Watch the dollar, watch yields, and watch the reaction function. On Tuesday, January 13th, the CPI print matters because of what it does to the market's rate path. If CPI prints hotter than expectations, the market challenges easier policy pricing, yields push higher, the dollar firms and metals feel it immediately. If CPI prints softer or comfortably in line, the market keeps leaning into the idea of cuts later in the year, and that keeps gold supported in the $4,450 to $4,500 zone, while silver remains the more violent expression of the same hedge demand. But there's a trap that breaks people psychologically. Even on a supportive macro print, silver does not always move in a clean, polite line. Silver is not just macro. Silver is flows. In a thin market, rebalancing, margin calls, and systematic positioning amplify day-to-day noise. That is why silver can be right on the week and still be brutal inside the week. If you need a smooth chart to stay involved, you will keep getting forced out before the move extends. Wednesday, January 14th, compresses the stress test into one session. Energy inventories and the Fed AS Beige book on the same day. That pairing matters because it links the three variables the market is juggling right now: inflation, activity, and energy. Inventories tell you whether crude's risk premium is touching real barrels. Beige book tells you whether the economy is cooling fast enough to justify the market's current policy lean. When those signals conflict, volatility rises because the market has to decide which one it believes. Then everything funnels into the end of the month. The January FOMC meeting, with the statement on Wednesday, January 28th, is not only about a decision, it is about language. Markets trade the trajectory. The reason metals had room to run this week is that policy expectations have already shifted toward easier settings over time. If the Fed's communication validates the market's lean, the support under gold and silver stays structural because the opportunity cost channel remains favorable. If the Fed pushes back, metals can still stay bid because geopolitical risk does not vanish, but the path becomes rougher because the rate channel starts pushing against the hedge. Now zoom out one step and you see why this week felt bigger than crude ES actual dollar move. The system is sensitive to rates because debt is sensitive to rates. U.S. interest expense has already printed at record levels, and fiscal headlines are not pointing to austerity. When interest costs are this large, every 25 to 50 basis points matters more than it used to. That is not ideology, it is arithmetic. When a system becomes arithmetic-driven, investors respond by holding more protection against policy error and financing stress. This is where the oil and metals split becomes the warning light. Controlled crude plus aggressive metals is not a simple reflation trade. It is closer to a stress hedge trade, where energy is being repriced for supply uncertainty and metals are being repriced for trust. That is why silver can surge even while crude refuses to break out. The market is not betting on booming demand, it is paying for protection. Over the next 4 weeks, the question is not, will oil hit $90 or will silver stay above 80? The question is whether the inputs that produced this week's repricing, geopolitical risk, inventory sensitivity, softer labor momentum, and shifting policy expectations, stay pointed in the same direction. If they do, the market keeps rewarding protection. If they do not, the market forces a reset, and the highest beta asset in the protection basket, silver, absorbs the impact first. So the discipline is straightforward. Do not trade the headline, trade the reaction. Watch how crude behaves after inventory data. Watch how metals behave after CPI and after the dollar moves. Watch whether yields rise and metals shrug it off, or whether yields rise and metals crack. That tells you whether this was a 1-week repricing or the start of a new regime. And if you want the cleanest signal of all, watch the ratio. When silver is outpacing gold, the market is not just hedging, it is reaching for torque. That is what happens when stress is priced quickly and liquidity has to adjust. If you wait for a perfect explanation, you're late, and that matters. Now we tie the whole week into one conclusion that an American or global investor can actually use. This wasn't oil up, metals up, as a generic inflation story. This was a market simultaneously paying for two different types of insurance: energy supply insurance and monetary credibility insurance, and that combination is exactly what shows up before volatility increases, not after. Look at the structure again. Crude moved in controlled bursts, 2 strong days, higher closes, and still a finish in the low 60s. That's the footprint of a premium being written into price, not a shortage being screamed into existence. The market is acknowledging that geopolitics can change the cost and reliability of supply, but it is not yet convinced that global supply is broken. That's why crude can be bid without sprinting. At the same time, metals didn't just rise, they repriced. This is where investors get emotionally trapped. They see oil not breaking out, and they assume stress isn't real. They see silver moving violently, and they assume it's irrational. Both reactions come from the same mistake, expecting one market to validate the other before acting. And that's not how repricing works. Repricing is fragmented. It shows up first where liquidity and flows concentrate, then spreads. If you need every market to confirm at the same time, you will always enter late, at the point where upside is smaller and risk is larger. So what should you actually do with this? In the next 1 to 4 weeks, your job is not to predict a number. Your job is to track which channel is dominating, supply risk or monetary risk, and whether the market's reaction function is changing. Here are the clean, non-negotiable tells. If crude rallies on a headline and then holds its gains after the next inventory report, that's not noise. That's the premium becoming stickier. A sticky premium means markets are starting to believe in real friction, not just fear. If crude rallies and then gives it back immediately once the data hits, the market is still treating risk as temporary and tradable. If CPI prints hot and yields pop higher and gold and silver still hold firm, that is not a metals trade. That is the market saying credibility is the bigger risk than rates. If CPI prints hot, yields rise, and metals crack hard, that tells you the rate channel is overpowering the hedge channel, at least temporarily, and the move needs to cool. For silver specifically, the highest signal variable is not the daily candle. It's whether silver keeps outperforming gold over multi-session windows. When silver outruns gold, investors aren't just buying safety, they're buying torque. That happens when stress is priced quickly, liquidity is adjusting, and the market is leaning into hedges with conviction. When silver underperforms gold, protection demand is still there, but it is more defensive and less aggressive. Now zoom back out to the bigger risk that sits under all of this: rates and debt. In a system where interest expense is already massive and fiscal headlines keep pointing to more spending, the sensitivity to yields rises. That means the market's tolerance for policy error falls. When tolerance falls, demand for monetary hedges rises, even if the economy isn't in a recession. You don't need a crash for protection demand to grow. You only need rising uncertainty about the path. That's why this week matters. Not because crude closed at $63 instead of $90, and not because silver flirted with $80. It matters because the market is telling you clearly that it is preparing for stress before the stress becomes obvious. And this is the final point you should not miss. The biggest moves don't start with consensus. They start with discomfort. Controlled crude plus aggressive metals is discomfort. It's the market saying, I'm not ready to declare a supply shock, but I'm also not comfortable trusting the monetary path. That is exactly the kind of tape that produces sudden repricing when a single data point or event forces positioning to show its hand. So here's your summary in one breath. This week, oil priced a controlled geopolitical premium while gold held strong. And silver surged with high beta, and that combination signals markets are buying protection against both supply disruption and monetary credibility risk. The next 4 weeks will be decided by reaction. How crude holds after inventory data, how metals respond to CPI and yields, and whether silver continues to outperform gold as the market reaches for torque. If you wait for the headline that makes it obvious, you're late, and that matters. The tape already spoke. Your job now is to listen while everyone else is still arguing.